All right, good afternoon. I understand that I'm probably the last speaker on the 2 days, so they say they keep the best till last. So hopefully we'll give you some tax updates, and you can see what's been happening in the budget. I was sitting down a couple of weeks ago and they said, what are you going to speak about for this lecture? And I couldn't rack my brains to think of something, and then Rachel stood up. Well, the Chancellor of the Exchequer to you and me. And I thought, well, that gives me an idea. I guess there's a few things in there that people might like to know. So I noticed that PPV have been going for 20 years. We've been acting for the best part of that period, over 13 years. And I'll give you some ideas. Let me just show you where we are with the slides. So that's me. We are chartered certified accountants, registered auditors, based in Barnes. And we are tax advisors as well. And at the moment, we're very busy with tax returns. It's our biggest quarter of the year. And the filing date for tax returns for the year ended 5th of April 25. The last date is 31st of January 26. So those of you that have got tax returns to do, that's when you've got to get them in. And you've got to pay your tax by that date as well. So I'll give you an idea. That's my CV. I don't know if you can see that, but some of the stuff we've done everything from, we acted for the largest landowner in Bucharest, Romania, largest telecommunications business in St. Petersburg, Russia. We've also acted for run-of-the-mill businesses such as Mark and Rob, and everything in between. Right, what I thought I'd start with, doing a bit of research, is you may have heard of Mark Carney. Mark Carney was the governor of the Bank of England, and he brought in something called forward guidance. And forward guidance I thought was really good. When people didn't know what was going to happen to interest rates, he used to give you a bit of guidance and say, look, don't be too worried. I'm not going to go up 5% or something. He didn't give exact figures, but he gave some guidance. I think what the trouble with this budget is bearing in mind the last budget prior to that was the 30th of October. This budget is very late on in the season, and the reason it's late on is because Rachel was hoping for some good news, and therefore we just had one last Wednesday, so that's very late in the season. It's always on a Wednesday, but it's a month later than before. Forward guidance is really good because what happens is people have changed the way they've reacted because they're worried about things that are happening. So people have been cashing in their pensions because there's pension lump sums you can take out tax-free, and I can run through that in more detail. People who are richer elements of the society have decided to leave the UK for some of those things that haven't changed, and I can run through with them. So bearing in mind that the top 1% of taxpayers pay about 30% of all tax, and there's something called the Laffer curve. So if you think of an upside-down teacup, people are saying, I don't mind paying 40 or 45% tax. If it goes up much more, I don't want to pay it. And if you go back about 160 years, those type of people were probably mill owners, and they couldn't easily leave the country. Nowadays, it's have laptop, will travel. And they're saying, well, I've got a laptop, I can do my job from overseas, so I fancy leaving the UK. And without forward guidance, what's happened is they've made decisions because they thought that Rachel may have brought in something a bit more aggressive than what she did bring in. So that means that people are changing their habits, changing their behaviours, and they're leaving. Some people have been leaving the country. So one of them that was in the paper a few months ago, the Livingstone brothers, they left the UK and they said their annual tax bill was £104 million a year. Now, £104 million, to give you an idea, is about 22,000 people on a basic salary. So that's the sort of kind of money you're losing. So if people like that decide to go, and some of our clients have, and there are places like Dubai, Monaco, Portugal, places like that, they're going there and they're making those decisions. And that, unfortunately, is not good for the economics of this country. So in order to do a bit of research, I looked at a few statistics to see how the budget has actually affected everyone and how they will affect us. So at the moment, 10p in every pound of government spending is interest on government debt. Government debt is running at just under £10 billion a month. That's just the interest on the debt. So that's about 110 billion with a B, billion pound a year on government debt. That's 10p in every pound. The welfare bill at the moment is 315 billion pounds. In the next 5 years, it will go up by 96 billion pounds. If the OBR have said that if we don't sort out our government spending, in the next 2 decades, we'll be bankrupt. That's akin to me having a client with a dodgy balance sheet and saying to them, I think you need liquidation advice. The problem we've got is the government spends over £1 trillion a year, and the money that's going out is not sufficient to cover, is too much, basically. It doesn't cover the money coming in, and if more of the rich people are leaving, you've got a problem because the tax isn't being paid, and they've got to sort of sort out the balance of the books. Now, I don't know if any of you have had a pay rise of 26% in the last 2 years, but the minimum wage people have. That's gone up from £8.50, I think it's just over £10, that's 26%. So what you've got to do is they need to sort out some of the things. So all these items, number 1s to 8, are items that were flagged that may have changed and didn't change. So number 1 is the exit taxes. So an exit tax is basically, if I've got a business, let's just say I've got a business and I'm lucky enough to have a software business and it's just floated on the stock exchange, but it hasn't made any money yet. So a lot of these businesses could go really well or could go badly. And there's a lot of businesses on the stock exchange that have got great turnover but aren't making profit yet, but they think it might go up and might come into profit. So then the question is, if I own that business and I left, I would be subject to an exit tax. Now, the main countries that have got exit taxes that you may be aware of are Germany, Canada, and America. And with those countries, what they have is a deferral system. Because if I left today, and if there was an exit tax, the government would say, well, you owe me this much. Well, the trouble is that my business might go like that, or it might go like that. And the trouble is, who knows? I will try my best to make my business work, but it might not work. Then the question is, if I get hit by an exit tax, I'm in real trouble because I've got a business that isn't making a profit. Everyone thinks it might go like that, but it doesn't always happen. So you need a sort of like a deferral system. The government haven't sorted out an exit tax, and they didn't bring one in, but I think it's going to be pretty complicated for them to actually bring one in and make it work. Wealth tax. Wealth tax has been sort of touted around for some time. Now, the wealth tax, I guess the common ones you may be aware of are Spain, Switzerland, and Norway. On the same vein, if you think about that limited company, the question is, what is my wealth? Well, the company, according to the stock exchange, is worth a lot of money, but I might not have the money myself. So in Spain, they don't value smaller businesses because they're saying it's too difficult to quantify. If you think a lot of your businesses, then it will be very difficult to quantify that value of the business because customers change, income changes, things like that. So that's a difficult one to do. I always find this funny, wealth tax. They say, oh, we need a wealth tax. Well, what do you think capital gains tax is? What do you think inheritance tax is? There's no country in the world that has capital gains tax, inheritance tax, and a wealth tax. It doesn't happen because they are wealth taxes. So to give you an idea, let's say I invested £100,000 10 years ago, and I sell that asset today, 10 years later, for £150,000. Any idea what my gain is? £50,000 is the answer here. That £50,000 is going to be taxed at my highest rate of capital gains because I'm not eligible for BAD-R, Business Asset Disposal Relief. So any of you that have got a trading business, you may be quite lucky to claim BAD-R. BAD-R is Business Asset Disposal Relief, shares in a trading company. I've got to be a director or an employee of that company. I've got to own at least 5% of the ordinary shares, have the rights to distribution or liquidation. And all those circumstances have got to be in existence for at least 2 years prior to the sale of the shares. And if I'm lucky to do all that, the first £1 million of my gain is taxed under BADR. BADR at the moment is at the rate of 14%. 6th of April next year, it goes up to 18%. Anything, so if I sell it for £2 million, the first £1 million at today is at 14%. If I sell it after the 6th of April 26, that first million is going to be at 18%. And then the next million is taxed at 24%. That's bad art. Anyway, my example, I've got £100,000 of asset. 10 years ago I bought it for, sold it today, 10 years later £150,000. Capital gain £50,000. 24% capital gains tax gives me £12,000. £12,000 is my capital gains tax liability. However, I would suggest to you that my real rate is nearly 100%. And the reason I say that is you don't get indexation relief on capital gains tax. So that means that my £100,000 that I paid for 10 years ago, in real terms, is worth £145,000, which is £5,000 less than I sold it for £150,000. That is virtually 100% tax. That's capital gains tax, no indexation. Then you've got inheritance tax. Inheritance tax, I'll come on to fiscal drag in a minute, but inheritance tax, I've got an exemption of £325,000. I can claim another £175,000 residence nil rate band. There are circumstances to doing that, but £325,000, that rate came in 2009 and it's frozen until 2030. That's 21 years, £325,000. If you work that out, that should be an enormous figure that you're getting relief on. And to give you an example, my mum, who's 91, bought her house for £14,000. It's now worth £750,000. She'd done nothing to it, lived in the house for over 60 years, and suddenly that's going to be taxed. Now, fortunately, she's got the inheritance tax exemption, but that gives you an idea of inflation. There's no relief for this inflation. The IHT band will get frozen for 21 years, from 2009 to 2030, at £325,000. The residence nil rate band is being frozen as well till 2030. The residence nil rate band you can claim if you leave your principal private residence to your heirs, children, grandchildren, and your total estate is less than £2 million. Above that, it gets tapered. Above 2.35 million, you lose the 175,000 completely, but you still get the £325,000 exemption. If you think that's bad, you wait till I come on to pensions. Pensions are subject to inheritance tax on the 6th of April 27, so that makes that one even worse. The other one they say about VAT threshold. The reason they weren't going to touch VAT is because VAT is inflationary. But at the and they don't want to stoke up the economy with inflation, so they weren't going to, I don't think they were going to touch VAT. But anyway, our VAT threshold is £90,000. £90,000 means that if I start a business today and I am, let's give you an example, I'm a sole trader today, then I have up to £90,000 turnover per annum, which is exempt for VAT. If I invoice more than £90,000 in a 12-month period, I have to be VAT registered, unless I've got an exempt supply. Let's assume I'm a window cleaner for the sake of argument. If I'm a window cleaner, then what I'm going to do is I'm going to stop work when my turnover gets to £89,900 because I don't want to charge my customers 20% more. So I do the windows for Mrs. Bloggs. At the moment, I charge her £100. If I become VAT registered, I'm going to add 20% VAT and charge her £120. Mrs. Bloggs is an individual. She lives at home. She's not VAT registered. She can't claim back the 20%. Suddenly, I'm 20% more expensive than my mate down the road, who's a window cleaner, who isn't VAT registered. So which one would you go to? So what they say is people artificially change the way they work if they're near the VAT threshold. Just to give you an idea, in Spain, the first €1 of turnover is VATable. In most of Europe, it's probably 25,000 euros. Portugal, places like that, it's about 25,000 euros. Our threshold of £90,000 is the highest in Europe. And they were saying there that if, say, me, again, as the window cleaner, if I dropped it to £45,000, if I couldn't live on £45,000, I'd have to be VAT registered, in which case all my turnover would be subject to another 20%. That would stoke up inflation in the economy, which is the government didn't want. That's why I think that one wasn't brought in. pension contributions at the moment, as long as you're not hit by the amount you earn, threshold, just over £200,000, you can put £60,000 into a pension and you can get that can reduce your taxable income. So, anyone got an idea what the highest rate of income tax you could pay in this country?
47.
Sorry?
47.
60 plus.
62. Highest rate that you won't see written down in the government statistics is 62%. Because so the way the thresholds work, the first £12,570 you earn is tax-free. £12,570 just over £50,000 is taxed at 20%. From there up to £125,140 is taxed at 40%. Anything above that, taxed at 45%. However, what you don't see is that when you earn over £100,000, your personal allowance, the £12,570, is deducted £1 for every £2 you earn over your income. So when you get to the tax band, 100 to £125,140, that band has a marginal rate of tax of 62% because you lose your tax-free personal allowance of £12,570. And that is a problem. And that is a big problem. And I'll show you later how much of a problem that will be. But people, again, change their earning habits because of those bans. Now, if I was lucky enough to have some spare money, and if I earned £100,000 and my boss said, I'm giving you a 10% pay rise to £110,000, that £10,000 pay rise would be taxed at a rate of 62% because I've lost my personal allowance. Do I say, I don't want the pay rise, or do I do something else? Something else could be, if I was lucky enough to have a spare £10,000, I put £10,000 into my pension, and my £110,000 taxable income goes down by the pension I paid of £10,000, so I'm taxed on 100. So I've effectively got a 62% tax deduction by paying £10,000 a pension, which is quite good value for money. That assumes you've got the money to pay for the pension, but you could do that if you plan your tax affairs properly. So you need to sort of know what tax band you're in and what rate of tax you're paying so that you can do something productive. National insurance and limited liability partnerships. So there's a lot of businesses, and one of them I'm standing in is a limited liability partnership. We set up the limited liability partnership for this business about 13, 14 years ago. And what they said the government may do is bring in national insurance. So if I am the director of a limited company, and if I get a salary, because I own the company, I'm the shareholder, 100% shareholder, and I'm the director, so it's my company, then I pay employers, because I am the company owner, and employees national insurance on that. So employee is paid by me, the salary, employers is paid by the company, which is my company. So in which case, you're paying 15% employers NI and employees NI on that salary. And that makes it very expensive. So what they said is that if you've got a limited liability partnership, then why don't we assess the members who are the partners of that business? So let's just say I'm lucky enough to have a business that's got a profit of £1 million. And let's say there's 4 of us. So that's £250,000 each. If we are members of an LLP, that £1 million will get taxed amongst the 4 of us, because an LLP doesn't pay profits, doesn't pay any tax. The individual members, so the 4 of us, pay tax on £250,000 each, which is the profit of the LLP. So therefore, at £250,000, the bulk of our income will be taxed at 45%. However, if that was a limited company with a profit of £1 million, you wouldn't be paying 45% because you need to leave money in the company, whether it's a company or an LLP. You've got working capital, you've got stock, you've got wages, you need a cash buffer. With an LLP, you're going to pay tax on that £1 million across 4 people, but you're not going to take $250 out because there'd be nothing left in the business. There's no working capital, no stock, nothing. So you'd end up paying tax more than you normally would. In a limited company, you might say, we leave, I don't know, £400,000 in, and then that will leave profits of 600,000, we'll take £150,000 each. That's a limited company, so you'll be taxed on £150,000 each. LLP, you're taxed on the total profits, which is £250,000 each. So LLP, and you're trying to compare apples and pears. LLP members aren't employees. They don't get holiday pay, they don't get sickness pay, they don't get paternity pay, they don't get redundancy rights because they're LLP members. So I didn't think that would work anyway, coupled with the fact they said, oh, we need to tax the big lawyers because they earn a lot of money. Well, I know one of the big firms in the magic circle isn't a limited liability partnership. It's a normal 1890 Partnership Act business. So that wouldn't even work. And then you could say, well, okay, what about barristers? They're multi-millionaires. I'm being very general here, but that was what was in the paper. But most barristers are self-employed. So they're not limited liability partners. They're not the 1890 Partnership Act. They're self-employed. So how would that work? So, and then there's lots of doctors' practices at limited liability partnerships. So that wouldn't work either. But the trouble is people have changed behaviours because of this, because they're worried what's going to happen in the budget. Basic rate of income tax, well, that hasn't changed. The government do have to, every year, they have to, because income tax isn't automatic, you have to mention, in the budget, they have to state we're going to raise income tax. The basic rate of income tax hasn't changed for trading profits. It's changed for lots of other things, but not trading profits. And the last one is gift holdover relief. Gift holdover relief is where if you have shares in a trading company, then you can pass shares around to other members, other family members, without crystallising capital gain. You can only do it as a trading company. You can't do it if it's a non-trading company. So what you need to do is a lot of this stuff, we're doing lots of gift holdover relief. We do family investment companies, family investment LLPs that they could do. There's a lot of stuff that you can do for tax planning that is very beneficial, but it's a bit like never say never. It may change. So you want to make sure that you take advantage of anything you can with this stuff. So this is pensions. So I said I'd come on to pensions, and from the 6th of April 2027, pensions are now subject to inheritance tax. So I had a client that came to see me on the 31st of October 2024. We'd planned it for ages, and it just so happened that there was a budget the day before, on the 30th of October 2024. This guy is very close to 70 years old. And he said, do you know what, Chris? The Chancellor has just pulled the rug under my feet for 40 years of tax planning. Since I was 30, I've been putting money into a pension on the assumption that I could leave that to my kids because my wife's got a pension and it's free from inheritance tax. Suddenly, I've got a massive problem because he's structured his affairs. Say his business was worth £6 million. I don't know the figure, say it's £6 million. That £6 million, he was going to leave the shares to all his kids, and you would claim business property relief, now called business relief, and you wouldn't pay inheritance tax on that. That's changed from 6th of April 26. First £1 million is relievable, not the 6 million that his business is worth. And then all his pension, that was all going to be free from inheritance tax as well. And that isn't either. So all his affairs are all being chucked up in the air. And there's a lot of tax planning, and it's the same for farmers. Farmers are agricultural property relief, businesses, business property relief. The rules are the same, the restrictions are the same, the problems are pretty bad if you haven't got time to plan. So a client came to me, he's 83, and he came with his son, and I'd explained to him all the pension rules, and he said, before I come, can you work out what my pension's worth? He's a very successful guy, his pension's worth £3 million, his wife's pension's worth £3 million. I told him the problem, and he said, don't worry, Chris, I'll take out £100,000 a year. Well, to start with, the £100,000 a year is all going to be taxed at 45% because it's on top of his existing income. But I did turn around to him and I say, Ian, you're 83. £100,000 a year for a £3 million pension will take you 30 years. The best will in the world, you ain't going to live 30 years. So he's now got to draw his pension down, and he'll be paying 45% tax on virtually all of that £3 million. And then what he's got to do, he's got to give it away before he dies. Now, if you make regular gifts of income, you can claim gifts out of income and you don't have to live the 7 years. If they're not regular gifts and they're capital, so you made a big lump sum to someone, one-off gift, you've got to live 7 years before you die, because otherwise it's a pet. A pet isn't one of these furry things, it's a potentially exempt transfer, a PET. Potentially exempt transfer. You've got to live 7 years. If you don't live 7 years, you could have an IHT problem. What people don't realise is that I sit down with clients and they go through their accounts and they say, oh Chris, can we add another £100 petty cash for my motor expenses? I said, you're missing the big trick. The big trick is capital gains tax and inheritance tax. So, to give you an idea with capital gains tax, got a client that bought a property 35 years ago near to us. He bought it for £150,000. He lived in it, then he's rented it out. I worked out the calculations and I said, do you know what your tax liabilities are on that? I haven't really thought about it. I could just give it to the kids, couldn't I? Well, yeah, but when you give it to the kids, it's deemed to be a gift at market value. So if you sell it to me today or give it to the kids today, you use the same figure, market value. That property is worth £1.75 million today. 35 years later, I explained to you there's no indexation relief on the increase in value of the property. So market value 1.75 million, cost 35 years ago £150,000, capital gain 1.6 million. 1.6 million times the highest rate of capital gains tax 24% is about 380 grand. The problem then is he hasn't got 380 grand, so then what do you do? Now, the next question is, okay, what I didn't want him to do is turn around and say, look, sod it, the kids can sort it out. If he says that and dies over the property, and let's assume that he's utilised his £325,000 inheritance tax exemption, that's 1.75 million at 40%, no relief for the purchase price because it's inheritance tax. So inheritance tax is at 40%, highest rate of capital gains tax is 24%. 1.75 million times 40% is 700,000. Which would you pay? 42% tax saving if you pay capital gains tax, but you've got to find the money to pay the tax. And then it's a residential property. So residential property means you've got to pay the tax 60 days after the date of gift. So any residential properties that you sell in the UK, you've got a 60-day window for paying your tax. In the old days, you used to pay it on 31st of January after the end of the tax year, but it doesn't work anymore. So the timing of it and the calculation of it are pretty critical. You may remember that 30th of October last year, all the papers were saying the bad news that we're going to raise the rate of capital gains tax, the highest rate of income tax. Well, I think the last time that was done was Nigel Lawson, but Nigel Lawson had indexation relief. Gordon Brown brought it down, but he's got rid of the indexation relief. So the problem you've got then is that you've got some massive tax bills you've got to juggle with. So capital gains and inheritance tax are a problem. You've now got pensions that are now going to be subject to inheritance tax on the 6th of April 27. So in this example, let's assume someone died. I don't know if you can all see that, but let's assume you die with a pension fund of £500,000. If you've used up your £325,000 exemption, that means you're going to pay 40% on that £500,000. That leaves you £300,000. You then leave that money to, let's say, your kids, who are all higher rate taxpayers. So they draw down the pension and they'll draw it down at their highest rate of income tax. And in that scenario, it's 45%. So they're going to pay income tax on the £300,000 because the £500,000 has already been taxed at 40% for inheritance tax. That'll leave you with £165,000, which is a tax rate of 67%. And just bear that in mind with what I mentioned earlier, the inheritance tax exemption is frozen for 21 years from 2009 to 2030, the £325,000 exemption.
So what's the way around it?
Well, the way around it.
Yeah.
Oh, well, that's why we're here.
Can you transfer?
That charge is extra for that.
That's fine, as long as I can save on that. Can I transfer it abroad, the
You
pension?
can transfer it wherever you want, but doesn't mean say you won't pay tax.
Or somewhere where the income tax is lower?
So there is new legislation on this. And don't forget that the country you go to may have a tax charge. So people say, well, look, I'm going to leave the UK, I'm going here, there, everywhere. You've got to be mindful of where you go, and you've got to make sure that how the rates work. So there's in the budget, they said, well, a lot of people said, okay, I've got this company, it's made a lot of money, I'm just going to clear off to Dubai, and I'm just going to take the dividends out. But they reminded everyone in the budget and reinforced the legislation, you take the dividends out, you're going to pay UK tax on dividends. So even if you're sitting in Dubai, you're still subject to UK tax on dividends taken out from a UK company. And the other thing is people say, okay, well, what I'm going to do is I'm going to go to Dubai and I'm going to sell the shares in my company, so I won't even be resident, so that won't matter. Well, just don't forget there's a 5-year tail. And the 5-year tail means that if you come back to the UK within 5 years, they'll give you a bill at Heathrow Airport because you haven't been out the country for 5 years. So capital gains, if you make a capital gain while you're non-UK resident, you can't just go out for a year and come back. It's not that simple. As you'd expect. I mean, they ain't going to make it easy. So that's the inheritance tax issue. This is an interesting one. I just thought I'd give you an idea of, well, this is the £500,000. It unfortunately still comes back to 67%. There isn't an easy way. You could say, well, if my kids are basic rate taxpayers, they might only pay 20%. But you've got to bear in mind that you got income tax relief on making your pension contributions. So therefore, whether it's you, your kids, or whoever that takes it out and draws down that pension, they're going to pay income tax on exit. And if the basic rate is 20%, then someone's going to pay income tax on it. The bit you want to avoid is paying inheritance tax of 40% on it. I thought I'd just run through a couple of things on the effects of the budget. I start with an astrophysics question. What is a black hole? So my basic knowledge of a black hole is you can't fill a black hole. So I was really worried on the 30th of October last year when Rachel Reeves said she was going to fill a black hole, because I think that's physically impossible. The next thing that worried me this year is the OBR released a letter saying there isn't a black hole, and then we had a budget from Rachel Reeves says there is a black hole. So I'm all a bit confused about black holes, but anyway, that was the first one. The question is, last year, 30th of October, she raised 40 billion. This year, she raised 26 billion, but she didn't increase income tax on trading profits. So the question is, how did she do it? Well, to my mind, it's a bit like when I'm on the tube and someone dips my pocket and nicks money out and I didn't even realise. Something called fiscal drag. Fiscal drag I've explained to you for inheritance tax. Fiscal drag for personal allowances means the tax bands are being frozen for 11 years. So it's a bit like my example with capital gains example. No inflation increase. So what that's doing is bringing people into a tax bracket that they weren't previously in. So let's assume I earn £50,000 on PAYE and my boss is very generous and he says, what we're going to do is we're going to give you a pay rise, Chris, and we're going to take you from £50,000 to £65,000. And I think absolutely fantastic, happy days. I'm a 20% taxpayer, 20% on £15,000, £3,000. That's brilliant. Unfortunately, £50,000, I'm a 20% taxpayer. I'm then going to, any other income I get above that is going to take me into 40%. The other problem is I claim relief for my kids, and that relief triggers between £60,000 and £80,000. So I'm going to lose a chunk of that as well. So what you're finding is they're bringing people back, and they reckon half of that 26 billion will be caught up by fiscal drag. So if we assume 3% inflation, for that period, that's a 9% stealth tax. So they haven't increased the tax rates, but stealth tax basically means you've got a 9% tax charge over that period. So we're then going to have £920,000 more people paying 40% tax because of that reason. And I mentioned before there's a problem when you're earning £100,000 at the moment. When I was doing some research for this lecture, I came across the acronym HENRY. Never heard of it before. High earnings, not rich yet. High earnings, not rich yet. They call them HENRYs. And what they're saying is that if I am a doctor earning £100,000 and they offer me some more shifts, they are turning them down because I'm saying, well, those shifts, I'm going to get £5,000, but I'm going to pay 62% on that £5,000. No, thank you very much. So the problem then is it's having effect on how people work, the type of work they do, and whether they do less work. And that's what they're calling HENRYs. And they reckon there's 500,000 more HENRYs. That's people earning just over the £100,000. So that's going to have a pretty detrimental effect on that. From the 6th of April 26, there's going to be an extra 2% on dividend tax. And from 6th of April 27, it's savings and property income. So for any of you that do your own tax returns, good luck, because you've got 6 tax rates there. 6 new tax rates that come in, which is 22%, 42%, 47%, which is the income tax that you're going to pay on savings and rental income. Just to bear in mind that they have changed the rules with regards to the personal allowance. Personal allowance used to be I could offset the income in any order I want. So given this, I'll be offsetting my savings income and rental income against my tax-free personal allowance. You can't do that now, they changed it in the budget. The other thing that you should note is that you may remember that George Osborne in 2015 announced Section 24, which was all of you landlords out there, you're going to get restriction on your mortgage interest. So let's assume I'm lucky enough to earn £125,140 on PAYE. That's the cusp upon which you pay 45% tax. If I go back to 2015, if I had rental income of £10,000 and mortgage interest of £10,000, let's assume that's my only expense. So my rental property does not make a profit. £10,000 rental income, £10,000 mortgage interest, no other expenses. 0 profit, no tax. Now, fast forward to today, the £10,000 in that example is going to be taxed at 40%, 45% actually, because it's just over the 125,140. For the £10,000 mortgage interest, I'm going to get 20% tax relief. So this rule is going to adversely affect people, which is why I didn't think they'd bring it in, because landlords aren't getting the same tax relief on that expense as the general public. So if I run a normal business, I'll get tax relief on my bank interest on the loan for my business. Rental properties, residential rental properties that is, you don't. The other thing you should bear in mind is that I've seen a lot of press commentary about this, which unfortunately isn't right. They are actually giving you the credit on the residential rental income up to 22%, not 20%, it was changed in the budget. So that means if like non-resident landlords, if I move to Greece today and rent my property out, I'm a non-resident landlord, which if I don't claim an NRL 1 relief, it means that the tax will be stopped either by the estate agent or the tenant at, in this case, when the new legislation comes in, 22%, not what is currently 20% of my rental income. And then I claim it back at the end of the year. You can elect to get it gross if your affairs are up to date. So it's the 22% that you get on that. So these tax rates are going to be quite difficult to keep track of. You will have noticed that at the moment, any idea what the basic rate of tax is on dividends? 8.75. So the basic rate has gone up 2%. If I'm in the higher rate, any idea what I'm paying at the moment? 33.75. It's now going to go up to 35.75 from the 6th of April 27. However, The additional rate taxpayers pay 39.35%, and that hasn't gone up 2%. So that one hasn't changed. But you will have to grapple with these, and you will have to get used to them, because the good thing about this is this gentleman here is saying, what can we do about it? You've got time. Dividends, 6th of April 26, savings and rental income from the 6th of April 27. You've got a bit of time to plan your affairs. You need to think how you're going to do it. So the question is, could I, for the sake of argument, put my rental properties in a limited company? Anyone know what relief I'd want to claim? I'd want to claim Section 162 incorporation relief, and you may have heard of a case of Elizabeth Moyne Ramsey. That's the one to do it. At the moment, you could do that. It gets harder, but what the government has said is the new rule is that from 6th of April 26 is that you actually have to claim that on your tax return, which you haven't had to do before. So that's Section 162 incorporation relief that you need to claim. I don't fancy paying an extra 2% on my rental income, so I put the properties in my limited company, and then what happens? Well, then I have to take it out by dividend, and I'm going to pay 2% extra on the dividend. So they sort of got you either way. So they'd sort of thought about that one. So it just restricts everything, and it makes the planning that bit harder. But you've got to sort of think of how you're going to deal with this, and it will mean that you're going to pay more tax if you don't do anything about it. So fiscal drag, like I say, is probably going to bring in a good chunk of that 26 billion. Then the next thing is EV mileage charge. Well, they say that at the moment, the fuel tax brings in about 25 billion pounds. I worked out that the government make taxes of about 33 billion in total if you add in other taxes that they get out of it. If they want us all to drive electric cars, that will go out the window. It just won't happen. So then they've got to bring in a mileage charge, which is what they're going to do. And they're going to do that on EVs, and I think they're going to bring it in on all cars. Now, I was talking to my son about it, and unfortunately these kids are bloody clever. So he said, well, what I'll do is I'll buy an electric car, assuming he had the money. I'll buy an electric car, flog it within 3 years, because it won't need an MOT, so no one's checked it. Unfortunately, they've thought about that, and they're going to think of bringing in a mini MOT. So the idea then is they can keep track of your mileage. So they it could have been the extreme where they put a black box in the car, but they didn't fancy forcing everyone to have a black box in their car. So then the way they'll do it is they'll have a mini MOT every year, keep track of your mileage, that will automatically be uploaded to the DVLC, and you'll get a bill. And that will be the way they're all going to do it, I think, because if there's no petrol, that's nearly 33 billion pounds of tax they ain't going to get. So they're going to bring in something, and this is the precursor for it going that way, because that's the way they're going to claim your money. And if you go to Europe, it's toll charges. Don't know, but they've got to make it up, and so they're forcing all the car companies to have electric cars. Well, this is the quid pro quo. So that's the way that's going to work. So let's see if I've got anything else. This is your saving grace, and it's called a limited liability partnership. And this is what we, Wilkins Southworth, have been plugging for years. And why has this, what merits has a limited liability partnership got? Why is it helpful? Why is it beneficial? And why do I think it's a good idea? Well, at the moment, if I've got a limited company, and let's say I own the company, and let's say I'm a higher rate taxpayer, so let's assume I earn more than £125,140. So I want to get my money out of the company. So how about I give myself a salary of £125,140? Not a very good idea. I own the company, so I am the employer, so I'm going to pay him 15% employer's NI. Used to be 13.8%, but it's gone up. Then, okay, I don't like that one. How about dividends? How about I take it out of dividends? Well, we know there's going to be an extra 2% dividend charge. And bearing in mind it is my company, so that company would have paid 25% corporation tax in the first place. Let's assume my profits are more than 250. If they're not more than 250, if they're below £50,000, it's 19%. Between 50 and 250, you've got a marginal rate of about 26.5% tax, corporation tax. So I've suffered that. So let's assume I'm making a profit of, let's take easy numbers, £1 million. So £250,000 has gone on that in corporation tax. You have to pay your corporation tax 9 months and 1 day after the end of the accounting period. So that's your first £250,000 gone straight away. So of my million profits, I've got left with 750. 750, how do I get it out? Salary, I'm going to pay 15% employers NI, and then me as the employee is going to pay employees NI, about 8%. Okay, next stage, dividends. Well, I know I'm going to pay an extra 2% on dividends. So this rate, I've got an effective tax rate of 54.5%. So that's 54%, 4.5% because I paid corporation tax plus income tax. I've got two rates of tax. Limited liability partnership only has one tax. You are taxed as a member, you're a partner. And that profit's the highest, is subject to income tax. There's only one rate of tax because LLPs only pay income tax. Highest rate of income tax, 45%. So that gives you an effective saving straight away. No P11Ds. So I'm quite lucky in my limited company. I fancy a Porsche. My wife's got a Range Rover. She works for the company as well. That would all be subject to P11D. The company would pay national insurance on the P11D for providing a benefit in kind to the employee. The employee is me. So I've got a taxable P11D, which will come through my notice of coding, and the company pays NI. So that's not a brilliant idea either. If you've got an LLP, you aren't an employee, you are a member, you own it. If this gentleman and I set up his business as market gardeners tomorrow, we are partners because there's more than one person. This is an old 1890 Partnership Act. It doesn't have to get registered with Companies House, it gets registered with HMRC. If we want the protection of the veil of incorporation, we would set up a limited liability partnership. Same protection as a limited company. It's got the protection of the veil of incorporation. Anything goes wrong, the contract is with the LLP and the customer, or if it's a limited company, the contract is with the limited company and the customer. Both have protection of veil of incorporation, both registered at Companies House, both have to file accounts at Companies House, financial statements. So the information you provide is very similar, but the way it's taxed is different. Hence why there was all that brouhaha about whether national insurance would be brought in. So, no P11D benefits in kind. So, let's say the partners are my wife and I've got a Porsche and she's got a Range Rover. No P11D benefits in kind. You can claim capital allowances on the car and the business usage of the car. If you have, if you borrow money to buy the car, the business element of that interest is tax deductible as well, as are the running costs. The business element of those is tax deductible. So that's the next one. No employees are members. Well, I've just explained that the government's, it was touted they might have brought in national insurance, they didn't. I think it was very difficult to do it because you're comparing apples and pears. So that's not there. This is quite fun. No restriction on use of home as office. Now, another thing that they chucked in on the budget, a small thing, is that they're trying to get people not to work from home. So if I'm working from home, I'm on PAYE, I can claim £6 a week. And that £6 a week I would claim an expense when I fill my tax return in for my PAYE income. They don't want me to work from home anymore. So as an employee, you can't make that claim anymore. If you've got a P11D, if you're self-employed, you're a partnership, there's no such restriction because the tax reliefs you can claim as an employee are completely different from what you can claim as self-employed. So the rules are different. So what you can claim is different. So the restriction they brought in this budget for use of home is for employees, not for people who are self-employed or in LLPs or in the old 1890 Partnerships Act. So it's different. So you can't do that. So there are things like that. The other thing you should bear in mind is the government say they don't want to wait as long for their tax to be paid. So if you are self-employed, you pay your tax every 6 months if your liability is more than £1,000. You pay it 31st of January and 31st of July. If you have a notice of coding, let's say I'm self-employed, but I've also got some PAYE income, and that PAYE income is, let's say, 20 grand. What they now want to do is to increase my notice of coding to grab some of the tax from my self-employed income to make sure I pay it earlier. And at the moment, they're going to discuss bringing it in earlier. So you may be aware that from 6th of April next year, something called MTD comes in, Making Tax Digital. Making Tax Digital, any ideas? So let's say, for the sake of argument, I'm a self-employed accountant, not a partnership, self-employed accountant. From the 6th of April, let's assume I'm in MTD. Any ideas how many sets of accounts I need to prepare next year?
5 or 6?
4. Quarterly.
This gentleman's correct, 5. 5, because I've got 4 sets of quarterly accounts and then the annual accounts. So what they want is you to send in accounts on a quarterly basis, and it covers rental accounts. If you fall within the rules, if you've got a rental property, you would also have to do that. It doesn't affect partnerships at this stage. But what they would then want to do is to know your income and expenses on a quarterly basis. And the reason this gentleman's correct is because you send the accounts in on a quarterly basis, but let's assume I've got a business, then I'm a self-employed guy that runs a supermarket, for the sake of argument. I've got stock, I've got debtors. So at the end of the year, I'll do a stock take, and I might find there's some pilferage, there's some wasted stock, and that will only come out when I do a stock take, and that's an annual stock take. So I'm not going to do one every quarter, and you don't have to do one every quarter. But that will come out then, in which case my last set of accounts may not be totally the same as the 4 quarters because of things like that. There may be some bad debts that I accrue, some things have come in, more creditors, etc., etc. So what that means is you're going to end up doing 5 sets of accounts, and you have a deadline to do it. And if I put my thinking cap on, I wouldn't say it's a million miles away from them saying, well, actually, if you give me 4 sets of accounts a year, you know what your profits are 4 times a year, so you can pay me 4 times a year. At the moment, self-employed person only pays twice a year, 31st January, 31st July. Yes, madam.
An immediate problem I can see is that a lot of businesses have peaks and troughs. So there'll be periods where you will earn more and therefore pay more tax, and periods where you will earn less. And I don't know how they're going to. And then when you pay the full year's accounts, that you're then getting into government possibly having to give you refunds.
No, I don't.
Is it going to be practical?
Well, I mean, none of this is legislation, it's all supposition.
Yeah.
But I don't see it that way.
Right.
What I see is that at the moment, so if I'm a non-limited company, self-employed partnership, limited liability partnership, they've mandated that my accounts have to have a year end of 31st of March or 6th of April. So if my accounts are 31st of March 2025, I pay the tax on that 31st January 26, 31st July 26. All they'll do is they'll use the same set of accounts, but they'll say pay it quarterly. Don't wait. I don't want to wait 9 months for my money, or 10 months.
You're going to have periods where you're perhaps not earning that.
No. What I'm saying, no. If I make profits in the year ended 31st of March 25, you should have put your tax away in the 31st of March 25. It should be sitting in a bank account somewhere.
But a lot of people don't.
Well, but that's not the point, is it? That's a different question. That's a cash flow question.
Yes.
But we're not saying that. So it should be there. What they're saying is they don't want to wait from the 31st of March 25 to the 31st January 26, 10 months to get the money. I want it sooner. That would be, I think, that's their angling. And if you look at what they announced in the budget, that's the way the way they're going.
Do you think that's a good thing?
Well, I mean, they will want your money, and the reason they want your money is the government are really bad at getting debts in, really bad. I mean, they reckon, I think, bad debts are £45 billion or something, because they wait too long. And you see these court cases, and they said, oh, Mr. Bloggs, he hasn't paid us for the last 9 years. And you think, how can it wait 9 years? So they are really bad at doing that, so they want their cash flow in sooner.
But you're not getting far off PAYE then, are you?
Correct, yeah. But what you've got to bear in mind, madam, is that if you are on PAYE, and they prefer everyone to be on PAYE, everyone, but you're paying your tax on a monthly basis. Self-employed people are paying it in arrears, and some of it quite significantly.
Yeah.
Now, I know they're saying you're making payments on account, but they want the cash in. And they want the cash in because they're so bad at collecting it from debtors. And there's a lot of bad debts, and they're bringing more legislation in for phoenixisms. So phoenixisms are where people set up a company and you'll rack up big corporation tax bills, VAT, close it down, and then that'll be ABC Limited. And next week they'll start ABC 2025 Limited. So then you have to put up bonds and things, and they're going to put more emphasis on that type of stuff.
I think it's going to disadvantage the people in the arts, because if you think of actors, for example, their peak earning is going to be pantomime. That's where the big money comes in. A lot of it's feast and famine in performing arts. It's going to be very hard practically for them to save up money they're not actually earning. Do you see what I mean? In the leaner periods where they know the pot's going to come in, maybe.
Yeah, but you're no different if you're an ice cream salesman.
Well, exactly.
I mean, there are people who are, I mean, what if I'm selling Christmas trees? I mean, there are always markets.
There are lots of parallel businesses, and I'm just sort of worrying for them, worrying about.
Worry too much.
I worry too much.
So I think limited liability partnerships should be considered. If you look at all the legislation coming in on limited companies, how you take out savings, income, dividend tax. If you've got properties, residential properties in limited companies, that too is going to be affected. So you just want to sort of bear in mind how you're going to get all this tax. So I think what you need to do is explore this lot. Number one, with the problems with the IHT, you need wills. You need to get your wills done. Hands up, everyone that's got a will. Okay, keep your hand up if you've left your pension to your wife. Well done, well done. Okay, brilliant. So, in that scenario, that pension, if I go back there, okay, this one. So, in that scenario, that guy died aged 75. If his spouse or civil partner was still alive, and if he left the pension to the spouse, you don't trigger an IHT liability, because any monies left between spouses doesn't trigger an IHT liability. So on the assumption that that pension was left to the spouse has time for him or her to try and do something, draw it down, give it away, whatever. You've got a bit of time. So you need to sort of think about how you structure your wills, and you need to take advantage of the spousal exemption for IHT. Got a client, he's 82, and my advice to him was he'd been living with his partner for 30 years and not got married. And there was a lot of money around. If you get married, there is time, because if you're lucky enough to have your spouse alive, you can use a spousal exemption. And that doesn't automatically trigger an IHT liability, and the surviving spouse can try and plan a bit. But you need to give them time. So A, you need a will. B, you need to be married for this to work, or a civil partner. And C, if you've got a pension, you need to make sure that the pension is left to the spouse, so you can take advantage of it. Anyone got any questions on that lot?
Got lots of questions. So what is the priority if you have different type of income? Let's say you've got interest, dividends, POAE, capital gains from stock shares. I don't know if you sell options and collect premiums, is that classed as a capital gains or income tax? How does it go into the staircase in the matrix? Which one gets?
So let's assume I am very rich, and let's assume I've got a lot of money. So I don't want to have income producing assets, because that income is all going to be taxed because I'm so rich at 45%. So what I want to do is I want that money to produce capital gains. So you can buy something, say, a zero coupon bond. The highest rate of capital gains is 24%, highest rate of income tax 45%, rising to 47%. Which would you rather pay? I mean, just think about it. It's nearly double the rate from 24 to 47. You're going to pay nearly double the rate of tax. So what you want to do is structure your affairs to try and create capital gains rather than income tax. And if you have an advantage, you want to try and do that, and you want to move your affairs around, because otherwise it's going to get expensive. If you get to a stage where there's more years behind you than in front of you, then you might want to consider making some gifts to family members, whatever, because you need to plan for this stuff. Like my client who's got a £3 million pension, if he takes £100,000 a year, that's 30 years. Well, he ain't going to live for 30 years when you're 83. So you've got to think, and if I've got a one-off gift, and if I'm 70 and I make that one-off gift today, I've got to live 7 years for it to be free for inheritance tax because it's a PET, potentially exempt transfer, PET. So you've got to sort of be thinking 7 years ahead with a lot of this stuff to make sure you're covered.
So I guess the question is, so you've got the capital gains charge of 24%.
The highest rate is.
And you've got the dividends at 30, 37 or whatever. Which one goes first? Tax in, like if you have 5, 6 different income.
Well, that's an easy one, because capital gains is taxed at capital gains tax rate and income tax at income tax rate, and never the twain's for me. If I sell a house, I can't say that house will be subject to income tax because I rented it out for 10 years. It's capital gain. So that would have no bearing on my income tax.
Okay.
So I could be paying, in that scenario, 24% capital gains tax on the property, and then I could have income tax on dividends, and they're completely different.
You've got 50,000, the basic threshold on income, and then you've got another 100,000 on capital gains. Do you get charged basic tax rate on that capital gains? 100K?
Well, if you used up your basic rate allowance, then that means that your income is taxed at the highest rate of 20% today because you are not earning more than the basic rate tax band, and your capital gains will be taxed. If you can't claim business asset disposal relief, you're going to pay 24% on that.
So in your example of the £3 million the guy has, if he was to, considering his age 82, if he was to give maximum amount of money as a one-off gift, is there a amount that you could gift as one-off? So could he not just
You could give the whole lot if you wanted to take the whole lot out and make a gift of one lot, but then it's a PET, potentially exempt transfer, because you're making one gift.
Yeah, but then it comes as a prorated. I mean, if he lives, say, for another 3 years, and then after, so then at least the 3 years is, you've taken that out, and it will be 4 years worth of amount taken.
But if he makes regular gifts of that pension, then it's not a PET. It's not a potentially exempt transfer because it's a gift out of income. So if he's taking out not 100,000, but say £300,000 a year, £300,000 a year, and he gives that £300,000 away, he'll pay 45% income tax on the 300,000, and then he can make gifts out of the whatever's left to the kids, regular gifts out of income, and that's a gift out of income, not subject to a PET.
Except he's paid 45% to get that money out.
Yes, but I think you're going to be resigned to doing that, because if he left that to his kids and the kids were taking it out, if they're taking £3 million out, but what he's done is avoided inheritance tax at 40%. That's the key to it. Because otherwise you're going to pay inheritance tax at 40% and then income tax at highest rate of 45%, and then that's where you get the 67%, and then it gets really expensive.
So how about trusts and stuff? How does it work? Is there any way around it with trusts?
You never say never, but I won't be able to do that in 5 minutes. So,
Hi, Chris.
Hi.
One of your clients, I spent 7 years teaching people to get marginal relief, that paid by fee, and then reducing their IHT bill. What do you think are the likely possibilities of reform, for example, taking over and reversing some of the stuff, especially the IHT bit? Do you think they would ever contemplate that in your view?
one of my clients did ask me that, and I said, well, the trouble is I wouldn't really bet the house on that and not take it out, because who knows? I mean, how big's your crystal ball is the question. Generally what will happen is that only because I've got a few grey hairs, is that normally an incoming government will say, look, I need to sort out this mess first before I start reducing tax. So if someone like Reform got in, I don't think they can afford to chuck it all away because we owe so much money at the moment as a country. We owe about £2.7 trillion. And to reduce the £10 billion a month we're paying in interest, they've got to get the debt down. And you need to get the debt down, so I don't think anyone, whoever comes in, is suddenly going to get rid of all these taxes. They might reduce them a bit, but I think they're going to have to address the problems. Yeah.
And then they'll always blame it on the previous government when they leave it in anyway. And say, well, it was them that did it, and it's here now, let's carry on.
Yeah.
Okay,
Yeah. That's the general rule, yeah.
How good is your crystal ball about Rachel Reeves lasting another few more months?
Keir Starmer said he's got, did he say I've got faith in her? Which I always think of football when they say I've got faith. When the chairman says I've got faith in the manager, it always worries me. Okay?
So you talked about the advantages of an LLP. If somebody has a 1980 partnership, do you advise...
1890.
Yeah. Do you advise them to make it into an LLP or just keep it as a general partnership?
Well, I mentioned that there's a very large magic law firm that is not a limited liability partnership. It's a case of whether you think you need to limit your liability. So do you need to protect what you're doing? And you might say, well, the business I'm in, I don't think anyone could sue me. Or if they could, I've got professional indemnity insurance, public liability insurance, I've got some really good letters of engagement, I've got some good lawyers, so I don't think I need to go to those lengths. So it just depends whether you need to limit your liability, and if you do, then limited liability partnership is the way to go.
So when we're creating or revisiting the will, what's your advice to having the will? So obviously you mentioned the pension to be left on the wife, obviously.
Well, my advice is to speak to a good lawyer to start with. We don't do wills.
Right.
I mean, you need to get legal advice to do wills. But the point is, all I'm saying to people is get one done. A client said to me, I said, have you done it? You remember we spoke last year and we had a chat, have you done it? No, I'm 90% there. I said, sign it. I said, what do you mean? Well, 90% there means you're not going to die intestate. If you don't have a will, you die intestate. It's a nightmare. You don't want to die intestate. Sign something, and you can always change it. That other 10%, you can tweak it later. But you should be revisiting your wills anyway. You might say, oh, I did it 20 years ago, it's in the bottom drawer. Well, circumstances change, family situations change. Just update it. But at least you've got something.
On my previous questions, can you transfer your pension abroad? Because I'm originally from Bulgaria, but I've been here 26 years. I'm not sure how difficult it is to change your tax status, but over there is a flat rate of 10% tax and there's no inheritance tax on pensions.
But you're going to be non-UK resident, so you're leaving the UK.
I can probably move back.
Well, it won't work otherwise. You can't just move your pension and say I'm still living in the UK,
course, yeah.
because that doesn't work.
Yeah.
I mean, you'd have to leave the UK.
How does it work with moving the pension? Is it straightforward or do you have to pay?
Well, I'm sure it's not, but we don't advise on pensions. You need an IFA to advise on pensions.
Okay.
But I mean, they ain't going to make it easy. Seth?
Marcus, the tax on the property income, I know it's obviously residential at the moment, what's the likelihood of that going to commercial?
What,
The tax on the property income?
that isn't just residential, that's all property.
Oh, that is commercial.
That's all property, yeah. It's not restricted to residential. The Section 24 relief is at the moment just residential, but the rate of tax is on all property, not residential property.
So the relief, do you think that's going to come in for commercial as well?
Which relief?
You just said that the tax on the tax is still the residential income,
So the high rate of tax is on all property income, not just residential.
Yeah.
And the Section 24 restriction on mortgage interest is only for residential. But the relief at the moment is at 20%, and that will go up to 22%. But that's only for residential property, not for commercial at the moment, but the tax is on all property. Yes, madam.
Chris, did you say the training companies that we set up has less of an impact because of the budget.
So which training companies?
changes. Sorry?
Which training companies?
No, if we were to set up as training companies, I mean, the therapeutic world, like training companies.
Trading.
Sorry?
Trading.
Yeah.
Trading or training?
Oh, no, training, not training.
Trading.
Yeah, training.
Oh, yeah.
I said trading,
Oh, trading. Oh,
and I
sorry.
referred to something called business asset disposal relief.
Got it.
So if you sell the shares in a trading company
Oh,
that qualifies for business asset disposal relief, so you need to be a director and employee, you need to own at least 5% of the ordinary shares,
Yeah.
and you need to be able to qualify for if the company's liquidated, and that must exist for at least 2 years prior to selling the shares. Then you would be able to claim business asset disposal relief, which at the moment is the first £1 million is taxed at 14%, going up to 18% on 6th of April 26.
Thank you.
Okay. Joe, how are we doing for time? You want me to? Yes, sir.
I keep hearing rumours that they're going to come after sort of crypto prior selling and getting any profits. So they're going to tax whatever you got. I'll take it even if it ends up being a loss later on. Is that true?
Well, you can't tax a loss.
They keep threatening it, because I know France threatened it last year.
I don't know about France, but you don't tax a loss. I mean, they're saying that they want all the exchanges, they're saying have to report to HMRC. And the idea is that if you are buying or selling currency, whether the exchange report it or not, you still have to declare it. You're in ITSA, income tax self-assessment, you assess your own tax. So therefore, if you made a gain or a trading profit, and generally, if let's say you buy Bitcoin and you hold them for 5 years and you sell it, and you make a profit, that's subject to capital gains tax. So that means that that is declarable. If you make a loss, you can also declare the loss, and you can carry the loss forward to offset against future capital gains.
Yeah, because I've got some of my crypto wrapped up in a loan. Technically, I need to pay that crypto loan off, and then whatever's left, now the market's tanked, it's even less. So I want to make sure that when I take any money out, I can't pull my pants down in 6 months for money that I don't have.
Well, I think you're saying that you borrowed money to buy the currency, yes?
I use the currency as an asset to get a loan
Okay,
to give to Rob.
okay. So,
Now it's all tanked, and land seized out the window.
okay, well, it's just think of it as a normal asset. If you sell it for less than it cost you, you made a loss. If not, you made a profit, and you pay tax on it.
Kind of hoping whatever is left is what I'm taxed.
Yeah, I mean, you've just got to work out the capital gain. You do the computation.
They missed me on the last one. They never came to me. So that.
Well, that doesn't quite work. Income tax self-assessments mean you assess your own tax. Just because no one came for you doesn't mean to say that you've got away with anything.
Is there a threshold to go back?
Well, the capital gains, fraud and willful default, no, if that's what they're alleging. But the point is that you have a capital gains exemption of £3,000. It depends what your gain is. But you should just assess it like you do everything else and put it on your tax return.
I assessed that it was on exchanges that weren't around or not around anymore. So that's 3 reasons.
Okay. Right, I think that's it.
Okay, yeah, I think we're just about out of time now. Could we all please give a big round of applause to Chris Wilkins?